Hey, welcome back, options traders. And I got an email from one of our traders asking for a review of what I call the 5 key moving averages. Now, obviously, there's a lot of different moving averages, right? A lot of different numbers. You can assign any number you want to any moving average. But what I found, if the moving averages are too small, things like the 9 and the 12 and the 20-day, you'll find that they just kind of wrap around the candlesticks. They don't really tell you a whole lot of information. But what I find is that there's a set of 5 key moving averages that probably reveal more information, especially when combined with the candlesticks, than any other grouping. And that's what we're going to talk about here. So, what are the 5 key moving averages and how do you use them? Let's go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, moving averages. Remember that moving averages can be used by themselves, but they are powerful to overlay with other indicators. So, if you use things like MACD or the CCI, RSI, stochastics, any of those, they become even more powerful. But just using the moving averages by themselves, especially with the candlesticks, become a really good way to figure out strong support, resistance levels, maybe where you can hedge, where you would like to speculate, sell calls a little more aggressively. They really can give you lots of insights if you know how to read them. So let's talk about the major moving averages. What are they? Well, there is the 50, the 100, the 200, the 500, and then even the 1,000-day moving average. Now, another thing that's nice about these moving averages is that they work in all time frames, and that should be true for any indicator that's at least worth anything at all. They should work in all time frames. So just keep in mind that if you are looking at a 50-day moving average and you flip your candlesticks over to a 1-minute candlestick, that's really the 50-minute moving average. If you flip it to a 5-minute candle, it's 50 5-minute periods, or every 250 minutes. But it's always going to be these same 5 numbers: 50, 100, 200, 500, and 1,000. Now, once you have these on your platform, there is a pattern within the moving averages that's very persistent, whether you're looking at major indexes, ETFs, or individual stocks. And again, regardless of time frame. So what is the pattern? All right, so let's start off with a simple example. Let's just assume that we have the first 3, the 50, the 100, and the 200. Now, if you see them running roughly parallel to each other, and by roughly, I mean there's just no overlaps, then that's a signal of a very well-defined uptrend, and that can give you beautiful insights for longer-term strategies, especially things like covered calls. You generally want to be buying these with the underlying stock in a very strong uptrend because you own the stock. So that's a first thing that you can kind of glean from looking at moving averages. Now, the second thing is that if your stocks, let's say, are above the 50, doesn't really matter which moving average, but if your candlesticks here, your prices are above, and they start moving up, there's a tendency when they get stretched too far to get pulled back down to the moving average. And that will be true again, regardless of where the candlesticks are. This is sometimes called like a rubber band theory. So you think of maybe a rubber band being attached to your candlesticks, and as it gets stretched away, it's starting to stretch that rubber band and become more like trying to snap it back down here towards the moving average. Now, how far is too far away? That really depends on individual stocks. Some will tend to drift further than others. But the main thing to look for is that whenever you pull away, the further away you are from it, there is a tendency for it to snap back towards that moving average. Now, once this happens, and it, let's say, comes down here and supports, again, regardless of which moving average it is, that's what we would call a technical support, in this case of the 50-day moving average. One of two things are likely to happen. You are either A, going to bounce, and that doesn't necessarily mean on the next candle. You could ride several candles along here, supporting, and then take off. but eventually you're going to see either a bounce or a break, which is called a technical fail in this case of the 50. And here's the first thing about the patterns. If you break the 50, or whichever one you're on here, there is a tendency for it to go to the next one in line. And then the pattern just repeats. If you get stretched away from it, there's a tendency for it to get pulled back. But if we come all the way up to here, to the next one in line, the one where it came from, in this case the 50, there's now a tendency for this to act as resistance. It's going to play the opposite. Remember when it was on top, these were areas of support. When it's coming from underneath, it's going to tend to resist. So kind of think of it like a ball bouncing along. If it's hitting the floor up here, it supports it. But if it's underneath and bouncing up towards the ceiling, it tends to resist. And now we're right back into the same pattern. One of two things will happen. You're either going to break, in which case we have a technical breakout, or you're going to fail and we come back to where you came from, the one that's next in line. Now, as before, when you're coming up from underneath, it doesn't mean just because one candlestick touches it that it has to either break or fail. You could get several of them kind of riding along here, but one of two things will eventually happen. It's not going to just ride that moving average forever. Now, another point to understand is that when I say that they come up to this moving average, it doesn't exactly have to touch. I usually teach traders that these are more like fat magic markers or a broad brush stroke as opposed to drawn with a finely sharpened pencil. So if you see that these candles are creeping up pretty close to the red line and then they turn, well, we would say that that's basically a resist off of the 50. Same thing here. They don't necessarily have to come all the way down here and touch. It might start turning just a little before. It might actually dip just below. But that's because this is a general range at this blue line, in this case, the 100-day moving average. And now the pattern just repeats. If we come down here in support and we bounce, we will most likely resist up here. If we fail, we will most likely come back to the next one in line. And you will see that that pattern persists, again, whether you're looking at broad-based indexes, individual stocks, ETFs, doesn't really matter. Doesn't matter about the time frame you're in. Now, it's also important to understand that there's not a real mathematical reason why this has to happen. They're just general markers that a lot of short-term traders will watch. And if everybody is buying when it supports, then guess what? It's going to support. And if everybody is selling when it gets back up to a resistance area, to the ceiling, then guess what's going to happen? It's going to resist because it's going to be met with a lot of selling pressure. So as long as you don't have any major news coming in the middle of this, it's just kind of your plain old ordinary day in the stock market. We don't have a Fed meeting. We don't have earnings, no real big news in the markets. Well, what else are you going to watch to try to figure out if you're relatively high or low? This is what most of your traders watch, are these 5 key moving averages. Okay, so with that little bit of an explanation, let's jump over to the E-Trade platform and see if we can find some actual examples that follow this pattern. Okay, so here we are into the E-Trade platform, and I'm going to start with the S&P 500, the SPY, and these are the 5 key moving averages. So we've got the 50, 100, 200, 500, and the 1,000. So the first thing to note is that you can see that these are roughly running parallel, at least meaning that there's no crossings. And that tells us that we're in a very well-defined uptrend. Since when? Well, when did we last cross? So this was maybe mid to late December last year, late 2023. So that's why it's wrong when you hear traders, let's say during this period, when they say that we're in a downtrend, or over here, or maybe even up here, you'll hear traders say we're in a downtrend. That is not true. That's a secondary trend, a trend within the big signal. The overall trend is still very much up, and I can see that instantly by looking at these 5 key moving averages. All right, so now let's look at the second principle that we talked about. When we get stretched away, what happens? Tendency for it to come back down. Came up, bounced off of here, came up, bounced off of here. If we come back in time, you can see here on longer stretches, get pulled away, back down to the red, get pulled away, back down, stretched away, back down. You can see that this just kind of persists until what happens? Until we break. And when we break, we tend to go to the next one in line, down to the orange or the 100. What's going to happen? One of two things. We will either fail the 100 and come to the yellow, the 200, or we will rise and possibly resist. And that's exactly what happened. Where did we resist? Right on that 50. One of two things will happen. We will either break out, technical breakout, or we will fail and come back to the next one in line. Way back up, resisted, way back down, supported, back up. For that one candle right there, you can see resisted. But once we break out, and what we're looking for is a 2-candle break, preferably with higher highs and higher lows. So like these two right there, actually the second and third candle in that little group right there would be our 2-candle break. And that's going to give you at least a little more confidence that we are probably going to have a stronger rally. What happens on the way back down? Now, if you get moving averages that are super close together, and especially if they're touching, if you're coming from the top, I would just count the bottom one. If you're coming from underneath, count the top one, whichever is furthest away from the candles. So because the red and the orange are so close together, I would really look for the orange for the 100 to be the support. Came back up here, a little bit of a fail, down to the orange, fail, down to the orange, back up. Now this is what we would call a false breakout. It did get through there, but we didn't get higher highs and higher lows. And remember, this is a fat magic marker. So you really shouldn't say that that was a break. It's questionable. Come back down, support, fail, came down to the yellow. Back up to the orange, back down to the yellow, up to the orange. You can see that this just persists. Now here's one where it didn't quite work out like you might expect. It did not come all the way down to the green or to the 500. Remember, there's no guarantees. This is not a crystal ball. It's just a general pattern. On the way back up, you can see that this continues. Look at this. The orange and the yellow, that's the 100 and 200, very close together. That's going to be a very strong support or resistance because we have two moving averages. So because we're approaching from underneath, we would expect that to be a much higher probability for a resistance, which is exactly what we got. On the way back down, support right along the 500. So you can just kind of see that these meander around in these moving averages, right back up to the 200, failed, right to the green, failed, all the way down to the 1,000. All right, so if you just watch, you'll see that that's a very persistent pattern. Look at this, right up to the 500. All right, so it's also important to remember it's whichever moving average is next in line. So what you don't want to do is to say, hey, we just broke the yellow, which is the 200, so the next resistance is the 100. Well, there is no 100 up here. The 100's down here. There's no guarantees that the 100 will be above it. It doesn't matter what the number is, it's just whichever one it's going to bump into next. So you can see from this yellow moving up, the next one it will bump into is the green. Same thing on the way down. Next one is now the 50. So you can see that this is just very much what the short-term traders are watching. Another fail right down to the 200-500 pair. Way back up, look at this resistance here. And again, once we get our 2-candle break, above whichever one is on top, tends to be the longest rallies. Fail, right back down to the 100. So these are things that you can also use to help you figure out when to enter maybe shorter term or longer term positions. I will always play the 500 and the 1,000. Most of the time I'll do something off of the 200 here in yellow. I rarely worry about the 50 or 100 unless it's for hedging purposes. But to initiate a position, typically not worried about the 50 and the 100 because they happen so much. Now, a lot of times traders are suspicious about the 1,000. They say, why? I've never heard of anybody trading the 1,000. It happens a lot. You can see right here, October 2022, right down to the 1,000. Kicker patterns off of there will almost always be the case. Super, super strong pattern. Now, here was COVID. We actually cracked through there And if that happens, then you can switch your time frames. And I'll show you how to do that in just a second. But first, let's go back over to fourth quarter of 2018. Many of you might remember that when they had all of the concerns about retail sales not coming in as strong, which is completely ridiculous that traders would sell off on such a short-term piece of news. But they did, right into a bull kicker pattern, right off of a 1,000-day moving average. Now, what should happen if you ever fall below the lowest moving average? So in this case, during COVID, what I did is we would flip over to, let's say, a weekly candle. Now, of course, it's going to reset us, unfortunately. So let's go back and see if we can find, there's 2020, there's COVID. So you can see pretty close to the 500. That was the next target to watch. Now, remember, there's nothing that says that has to be hit. Let the market tell you where that turning point is. But once we got these kicker patterns here, that's it. You knew that was the V bottom. You can see right here, even on a weekly candle, right down to the 200. All right, so these just persist through time. Let's go back to a daily candle. Let's try one more real quick. I think hopefully you've got the hang of it. But let's go to Apple. Let's see if we picked up these same patterns here. Let's go back to, first let's get our 1,000-day on there. So there's fourth quarter of 2018, right down to the 1,000 kicker pattern off of it, right here, right off the 500. All right, so you can see that these definitely persist. This was COVID. Look at Apple, right off the 500-day. Kicker pattern right off of it. So you pretty much knew, not a guarantee, but that's a pretty good place to establish a long-term play. And again, the patterns just persist. We get stretched away, back down to the moving average. Pulled away, snap back down. If we fail, down to the next one in line. Breakout, this didn't last too long, came right back to the orange. Breakout, down to the orange, failed the orange, down to the yellow. Failed here, down to the yellow. You can see here, failed the orange, down to the yellow. Back up, failed the yellow, down to the green. So once again, it's just to show you that there is a very persistent pattern within these 5 key moving averages. And if you use these in conjunction with your candlesticks, it can give you really, really good insights into the longer term trends, which remember, that's where the money is. So if you're having problems with generating profits with options and you're going the real quick in and out route, it just doesn't work, especially in the long run. Learn how to use your moving averages and your candlesticks, and you will be on your way to much bigger and more consistent profits. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.